Traditional investing relies on a very slow, linear mechanic. You buy an asset and wait months or years for the value to slowly appreciate. But what if the market suddenly crashes? Or what if you want to trade a massive volume of shares to maximize your returns, but only have a small fraction of the required cash on hand? To bypass the slow crawl of traditional stock ownership, you use a completely different financial instrument: options trading. One group of traders views options as a high-speed vehicle for wealth. These are speculators. They use the contracts to predict short-term price movements, attempting to multiply their money rapidly. But look at the portfolios of the largest, most conservative financial institutions in the world, and you will find them using those exact same contracts as an absolute defense mechanism. It is a unique financial paradox. A single options contract can function simultaneously as a high-risk gamble and an ironclad safety net. For the speculator, the entire appeal of an options contract comes down to one single, incredibly powerful mathematical advantage: the use of leverage. This chart shows the baseline math of a traditional stock purchase. You invest 1 lakh rupees to buy 1,000 shares of a company at 100 rupees each. If that stock grows by 10 rupees, your return is a flat 10%. In the options market, you don't buy single shares. Regulators like SEBI mandate that options are traded in standardized blocks called lots. Now look at what happens when you apply that same 1 lakh rupees to an options contract instead of buying the stock outright. The capital required per share drops, meaning your 1 lakh can purchase enough lots to control the equivalent of 2,000 shares. If the underlying stock goes up by that exact same 10 rupees, the math shifts entirely. Because you control twice the volume, you generate a 100% return on your initial investment. Leverage multiplies your purchasing power without requiring more capital, but the math works in both directions. If your prediction is wrong, the leverage will drain your account just as aggressively as it built it. That severe risk profile is why conservative investors approach options from the opposite direction. They use them as an insurance policy against unforeseen market disasters. This is done by purchasing a put option. You pay an upfront fee to secure a guaranteed strike price. This is a specific dollar amount at which you are legally allowed to sell your shares later, regardless of market conditions. Let's trace how this behaves during a crash on this graph. The red line is the open market. If a crisis hits and the stock plummets, your portfolio value, the second line, drops until it hits your predetermined strike price. At that point, it hits a firm floor. You are completely protected from any losses below that specific number. Hedging demonstrates that options aren't inherently dangerous. They simply allow you to pay a known cost today to intentionally offload your downside risk to someone else tomorrow. Whether you are speculating on a massive surge or hedging against a catastrophic crash, you have to pay a fee to enter the contract. This upfront cost is called the option premium. This premium is meticulously calculated by summing up two entirely different metrics. This visual equation maps out the first half. You take the current market price of the asset, subtract your contract's strike price, and the exact difference is your intrinsic value. Intrinsic value is grounded in present reality. It dictates what the option is mathematically worth if you were to exercise it right now. But then you add extrinsic value, often called time value. This is the additional fee a buyer pays for hope, the probability that the option will move further in their favor before the contract ends. External variables dictate this number. If the market is experiencing high volatility, or if there is a long runway of time before the contract expires, the extrinsic value swells. Paying an option premium means you are simultaneously purchasing an absolute mathematical truth and a calculated probability of the future. Because of extrinsic value, options traders must outmaneuver the rest of the market, while simultaneously fighting a literal ticking clock. This step chart illustrates time decay. As the expiration date approaches, the extrinsic value of the option steadily bleeds away. To succeed, an option buyer must correctly predict the market's direction, the exact magnitude of the shift, and the precise time frame in which it will occur. Fail to predict the timeline, and a speculator can be completely correct about a stock's direction, but still lose their entire investment as the time value evaporates. The intimidating jargon of options trading, premiums, lot sizes, time decay, can feel like a barrier to entry, but these terms are deliberately designed to quantify and organize the chaos of financial risk. Options are ultimately a neutral tool. They grant you absolute control over your financial exposure, whether you are seeking extreme wealth or extreme safety, provided you learn their exact